So we'll go to financial objectives, right?
Yes, financial objectives. No, we didn't.
No, just want to start. So financial objectives, these are monetary targets or monetary goals of the business. This is what we call financial objective. So what are the types of financial objectives we're talking about? We have survival. For survival, as businesses, sometimes business conditions, business situation, especially let's talk about new businesses, like a business that is just starting up. As a new business that is starting up, it is difficult for you to enter the market and start gathering customers. It's difficult because there are existing businesses in the industry. So the first thing you have to do as a business at that point in time is how to be in existence, how to continue with the operations, not to think of making profit at a go. So as a new business that is starting up, your objective might be to survive, might be to be known, might be to continue to be relevant. You understand? At least for the time being, you want to also try to be part of that market. So you might not be thinking of or aiming at making profit. You want to survive. You want to continue to be in existence. You don't want to lose. You don't want to go back. You don't want to lose you don't want to be out of the market. You don't want to be out of the industry. So a new business would not think about profit immediately. It would think about survival. So survival means to be in existence, to continue to be in operations. Even for existing businesses might also think about survival, especially when there is economic downturn, when there is economic decline. Things are not working fine. Recession. During recession, economic activity are falling. Demand for goods and services would fall at that time. Then businesses might not be able to make profit. So they will think about how to survive that situation. So that is survival. Is it clear? The second one, profit. For profit, this is the return on investment of owners of the business. Profit is the return on investment. As owners of the business, they've invested money into the business, yes or no? They've invested capital into the business. So they want return on their money. They want return on their investment. So the target of a business, sometimes it's to be able to make profit for the owners of the business, which the owners of the business will get through dividends. Do you get it?
Yes.
So that is about profit. Then we have profit maximization, which means you want to make as much profit that is possible. The highest possible profit that is available in that market, you want to make it. That is what we call profit maximization. Do you get it?
Yes.
Making as much possible as possible. Making as much profit as possible. Clear? Then we go to shareholders. Who are the shareholders? These are the owners of the business. So as soon as the business makes profit, the owners of the business would be getting dividends. So the more profit the business make, the higher the dividends given to shareholders. I think it's clear.
Yes.
So the shareholders will not get profit, they will get dividends, which is what? Share of profit. Is it clear?
Yes.
So another financial objective is sales. So this implies to the volume of what the business wants to sell, the volume of what you are selling. If the volume of your sales increases, your revenue would increase. Then you could make more profit. So a business might think of increasing its sales volume. That's another financial objective. It is monetary, isn't it?
Yes.
All right. Then, why do businesses think about increasing their sales? The first point I make here is that it leads to lower cost. When you have to increase your sales, when you have to increase your sales volume, what do you have to do? You have to expand your business. Yes or no? When you are expanding your scale of operations, it means you'll be able to enjoy economies of scale. Then you have a reduced cost of production, which is good for the business. But a business that is producing less will sell low. Then at that point in time, your cost of production might increase. Do you get it?
Yeah.
The second point is that it increases your market share. When you produce large quantities, that means you have a lot of product in the market, which means it can reach large numbers of customers. Do you get the point?
Yeah.
The third point, it increases the reputation of the business. Because your business is known everywhere, you will gain popularity. A lot of customers will know your product. A lot of customers will know your brand. You are gaining popularity because of selling large volume. Do you get it? And the last point here is that it generates wealth for the owners of the business. It increases the owners of the business assets. Your assets will increase because you have a lot of trade creditors, you have a lot of equipment. Your assets are increasing because your business is getting bigger. Do you understand financial objectives here? Is it clear?
Yes.
Then another financial objective, that is for sales. Another financial objective is to increase your market share. When we talk about market share, we're talking about the total brand sale divided by the total market sale multiplied by 100. So that means the percentage of what your brand sell, the percentage of what your business sell in the whole market is your market share. Do you get what I'm saying here? So the total of your product divided by the total products in that market multiplied by 100. That is how you measure, that is the formula for market share. So what market share means is that you want to gain customers. So another financial aim of a business is to gain more customers. And when you are gaining more customers, it means your competitors are losing customers. If you are gaining more customers, your competitors are losing those customers because there are no customers in heaven. All the customers are here. So if you are having them, it means your competitors are not having them. Do you get it? The next one, financial security. Some owners of the business want to make profit that is enough to fit or to food or enough for their own profit, that will be enough to secure their financial status. They don't want large profit. They just want profit that is enough for their lifestyle. We call it profit satisficing. They don't want to maximize profit. They only want to make profit that is enough, that is good enough to live their lifestyle. Do you understand? Most of the reasons why owners of the business do this is that they don't want to take so much responsibility. Because the more the business becomes bigger, the more responsibility you take. So because they don't want so much responsibility, they don't want to take more risk, they want profit satisficing. Just to make enough profit that will fit into their lifestyle. Is it clear?